All right, time to bring in our next guest. That's going to be Luke Gromen, founder and president at FFTT. Welcome back to the show, Luke.
Thanks for having me back on, Tom. Great to be here.
All right, so perfect day for you to be here ahead of that Fed decision with equities, still powering higher. We've had some weakness, a little bit of volatility this week. What's your take here? The expectations, 25 basis point cut, maybe a hawkish tone, Luke?
Yeah, I'm still trying to digest the actual meaning of hawkish cut. To me, it's like one of these great paradoxical terms, and I actually do think it's a signpost of sorts from the standpoint of, I think they know part of the economy desperately needs a cut, which is to say the U.S. government's deficit desperately needs liquidity, while at the same time they've got to be noticing what's going on in terms of some of the private sector liquidity, where you've got literally meme coin Fartcoin that is, I didn't even know existed. I thought it was a joke, but it's an actual thing, and it's trading bigger than 40% of publicly traded companies right now in terms of market cap. So there's this dichotomy. I get why they're having to say hawkish cut. We'll see how it plays out.
Yeah, and I think that's the divergence that we've seen, where a lot of people are saying, hey, we don't need a cut because of the strength in the economy. Job market's pretty robust at this point, but the market wants what it wants, Luke, and with valuations at these historical highs as far as the S&P 500 goes, it's almost like they can't not do it at this point because it's going to roil the markets, and I think the Fed's worried about that, right?
I think that's right, and I think in particular as it relates to the fiscal situation of the U.S. I mean, it's incredible to me that U.S. what we've called true interest expense, which is entitlements plus interest, the gross interest portion, has been 103% of U.S. receipts over the last 4 months. So despite all of this sort of private sector liquidity we see evidence of every day, despite stocks doing what they're doing, the government can't even cover its interest and interest-like obligations in terms of receipts, which, and given that there is a slightly lagged but very tight correlation between stocks and U.S. receipts, the implication is that if stocks fall and stay down for just a little bit, the fiscal situation goes into a spiral. So that's the tricky part of the environment that we're in, and it's an environment that in the United States we haven't been in ever in anybody who is presently trading or investing's career. We've been in this position in emerging markets before, but not in the United States, and so it does make for a very tricky environment.
When you look at this, risk on assets pretty elevated as far as valuation. You mentioned Fartcoin. We got Bitcoin just below all-time highs. Maybe some of these meme stocks picking back up traction here a little bit. With this administration wrapping up and going into a new one, do we get a reset or a fix on some of that deficit that you mentioned? And that might be, a little bit of pain maybe for the equity markets in the near term. And then we reset a little bit. Will that help?
I think it's entirely possible. For me, as I look out over the next 3 to 4 months, I have absolutely no conviction in where things could go. And the reason I say that is precisely for that true interest expense being over 100% of receipts, which is all else equal, that should power the dollar higher. And if the dollar goes even just a bit higher from where it's sitting today, we're going to go right back into that third quarter 23 or mid 22 market regime of dollar up, everything else down. You're already seeing the bond market, the long end of the bond market, get a little a little lively with the 10-year over 4.4 today. However, so for the next 3 to 4 months, I have no idea. I think it's entirely possible, particularly since tariffs, it's going to drive the dollar up. Things will break very fast. Doge, if they say the wrong thing, if they cut the wrong thing, dollar goes up just a little bit more from here, they're going to break everything, basically, very fast. Dollar up, everything else down. Now, once we get beyond 3-4 months, I look at Scott Bessent's 3 arrows, I look at what Trump's talking about, I look at the policies of this government, and they need a much weaker dollar to do any of these things. And so I think they'll ultimately get their weaker dollar, which is great for it's great for growth. It's great for U.S. growth, global growth, nominal inflation. It's great for stocks, industrials, Bitcoin, gold. It's even great for the long end of the curve because it ultimately frees up private sector balance sheet capacity to help finance these massive U.S. deficits. But it's like being between two trapezes, right? You know, we're going from one administration to the other. I don't know what happens in the next 3-4 months. I have no conviction, and so I advise investors to plan accordingly, to kind of stay low over your skis. But looking out 6 months to 12 months, I think the dollar is going to be quite a bit lower, and I think that's ultimately going to be very good for equities, very good for growth, very good for global growth.
What's the catalyst? Because you've been talking about that on the show here, Luke, with us for a while. We've got the dollar sitting at 107. It's elevated. You mentioned the 107, 108 levels before, where it becomes and causes maybe some pain for the equity markets at this point. What are the catalysts that can bring that dollar down quickly, where we can kind of reset, where it might hurt equities for a little bit, but we've got room? We're up 27% so far this year in the S&P 500. So we definitely have some ability to maybe pull back and just not fall out of bed, right?
I think so, but the challenge is that when you have debt to GDP at 125% in the U.S., and there's, you know, things get very binary very fast. When you're running 7% deficits, when you're dependent on stocks for receipts, it feeds on itself fast. So I would totally agree we have a little bit of room that you could maybe take things off the boil a bit. But look, over the last 4 weeks, we've had 2 20-years and a 30-year Treasury auctions that have not been very good, with DXY at 106, 107. We've had now the 10-year is up to 441. It just kind of keeps creeping up. The long end will keep getting worse if the dollar keeps creeping up, and that could be your catalyst for for maybe a brief period of volatility in stocks, and that could kind of get you to help take some of this off the boil. But ultimately, California is a poster child for it. Bloomberg reported recently that 10% of California's budget is coming from the stock-related comp of just 4 companies. So if those 4 companies, and we know what they are, right? It's Facebook, Google, Apple, and so if stocks fall, California goes right back into a deficit. And if they stay down, California's got a huge budget. And so it's one of these things where they've allowed the system to evolve this way, right, where they can always let things come off a boil, but they can't let things come unwound, which at leverage levels we have will happen fast. So it's a very delicate dance they have to do. I agree you could, and that's why I think for the next 3-4 months, who knows? I have no conviction. But ultimately, they got to get that dollar down, or else they're going to have some really big problems. Yeah, and I don't think people are focused on that, because I keep on hearing S&P 500 targets continue to move higher without delving into maybe the issues that are behind this. But, the Fed's in a tight spot here, Luke, at this point, because, if they cut 25 basis points, maybe they shouldn't, because inflation's firmed up over the last couple of months here. And then also, you've got risk on assets, wealth effects kind of taking place here, where, hey, if yields continue to rise, inflation continues to firm up, they shouldn't be cutting. But at the same time, they want to cut, based on what the market's telling them at this point, Luke. Yeah, this is ultimately where this was always going to go. The Fed's mistake this time, and we've been saying for over 2 years, was they didn't let inflation run hot enough for long enough in 21. And 20 and 21 and into 22 to get debt to GDP down. And so, when you try to play Volcker with the sovereign balance sheet of Argentina in 2002, literally, our debt to GDP is the same as Argentina's was in 2002, you don't get Volcker 1980-like outcomes. You end up with where we are today, which is, they need to cut because the fiscal situation is in bad shape, because our own cuts have bid up interest so that our deficit is starting to be problematic. But the private sector needs arguably no cuts, if even maybe modest hikes, to take some of the broth off the boil. And, it's the riding 2 horses with 1 rear end metaphor we've been using, and the horses are bolting in different directions now. And so, that's why I think ultimately we get this hawkish cut dynamic, is it's almost, to mix my metaphors, it's like, these are not the droids you're looking for mind games. It's a hawkish cut. We are responsible on inflation, but we're cutting rates. Well,
Yeah.
Which is it, right? So it's a tough position the Fed's in, and they've got nobody to blame but themselves. They needed to let inflation run hotter for longer. Then they would have more flexibility because you could say, hey, we're gonna raise rates, or we're not gonna. They back themselves into this corner by doing what they did 2 years ago.
Yep. I expect some volatility over the next couple of months, and I think you do too. All right, great discussion, Luke. Appreciate it. Have a great day.
Absolutely. Thanks for having me on again, Tom.
All right. Good to have you. Thanks to Luke Gromen, founder and president at FFTT.